October 19, 1987. Black Monday. The stock market crashes 22.6% in one day, the worst crash in modern history. Billions of dollars gone. Investors are panicking, brokers are crying, hedge funds are collapsing. But in a small office in New York, one man is smiling. Paul Tudor Jones. He predicted the crash. He went all in on the short side. Result? He made $100 million in one day. His fund returned plus 62% that year, while the world lost trillions. But this wasn't luck. Paul Tudor Jones started as a cotton futures trader in 1976. His mentor? Elliott Tullis, a legendary commodities trader. Eli taught Paul one rule: don't focus on making money, focus on protecting what you have. Paul took that to heart. 1980, Paul starts Tudor Investment Corporation with $1.5 million. Today, Tudor manages over $20 billion. Paul's personal net worth? $7.5 billion. So, how does a cotton trader become one of the greatest macro investors in history? And what are the 20 rules that turned $1.5 million into $20 billion? Let's break it down. Paul Tudor Jones says the most important rule in trading: defense first, offense second. Here's his logic. Most traders think, how much can I make? Paul thinks, how much can I lose? Example, 1987. Paul sees the market is overvalued. He doesn't go all in immediately. He risks 1% of his capital on each trade. Even if he's wrong 10 times, he only loses 10%. But when he's right on Black Monday, he makes 62%. Paul's principle: the most important rule of trading is to play great defense, not great offense. Paul Tudor Jones has a famous saying, losers average losers. What does that mean? Most traders do this. They buy a stock at $100. It drops to $90. They think, it's cheaper now, I'll buy more. It drops to $80. They buy more. It drops to $70. They're wiped out. Paul's rule? If you're losing, get out. Don't add to a losing position. Example, Paul trades cotton futures in the 1970s. He buys cotton at 80 cents per pound. It drops to 75 cents. His mentor, Elliott Tullis, says, cut it, now. Paul cuts the loss. Cotton drops to 50 cents. That one decision saved his career. Paul's principle: when you're in a losing position, the best thing to do is get out. Paul Tudor Jones only takes trades with at least a 5-to-1 risk-reward ratio. Here's how it works. Paul risks $1 million on a trade. His potential profit? $5 million. If he risks $1 million, his stop loss is $1 million, but his target is $5 million. Example, 1987. Paul shorts the market. Risk, 10% of his portfolio. Potential reward, 60% plus. That's a 6-to-1 ratio. Result? He makes $100 million in one day. Paul's principle: I only trade when I have at least a 5-to-1 risk-reward ratio. Otherwise, I don't play. Paul Tudor Jones is a macro investor. He doesn't pick individual stocks. He trades interest rates, currencies, commodities, stock indices. Paul studies Federal Reserve policy, inflation data, GDP growth, currency flows. Example, 1987. Paul notices interest rates rising. stock valuations at record highs, corporate debt exploding, dollar weakening. He connects the dots. The market is going to crash. He goes short. Result? Plus 62% in 1987. Another example, 2008. Paul sees housing prices unsustainable, subprime mortgages exploding, banks over-leveraged. He shorts financials and housing. Result? He makes hundreds of millions. Paul's principle: macro is the only way to make real money. You need to understand the big picture. Paul Tudor Jones is a trend follower. He doesn't predict, he reacts. His rule: if the market is going up, go long. If the market is going down, go short. Don't try to catch the bottom or call the top. Example, 1987. The market has been going up for 5 years, but in August 1987, the trend breaks. Paul sees the break. He doesn't wait for more confirmation. He goes short immediately. 2 months later, Black Monday. Another example, 2020. Paul sees Bitcoin breaking out. He doesn't say it's too expensive. He follows the trend. Bitcoin goes from $10,000 to $69,000. Paul's principle: the trend is your friend. Don't fight it, ride it until it ends. Paul never enters a trade without a stop loss. His rule: know your exit before you enter. Example, every single trade Paul makes has a stop loss at 1 to 2% of portfolio. Traders without stop losses? They blow up eventually. Paul? He survives for 40+ years. Paul's principle: don't focus on making money. Focus on protecting what you have. The losses will kill you. Principle 7. Cut losses quickly. Let winners run. Paul's rule: if you're wrong, admit it fast. If you're right, hold. Example, 1987. Paul cuts 20 losing trades, but he holds his Black Monday short. Result? Plus 62%. Principle 8. Use leverage wisely. Paul uses leverage, but not recklessly. His rule? Leverage amplifies both gains and losses. Use it when odds are in your favor. Example, 1987. Paul uses 3-to-1 leverage on his Black Monday short. Small position size, big leverage, massive payout. Principle 9. Be flexible. Change your mind when data changes. Paul says, I don't have an ego. If I'm wrong, I change. Example, 2020. Paul is bearish on stocks, but when Fed prints trillions, he changes, goes long, makes millions. Principle 10. Study history. History doesn't repeat, but it rhymes. Paul studies every market crash in history: 1929, 1973, 1987, 2000, 2008. He looks for patterns. Example, 1987. Paul notices same pattern as 1929 crash. He prepares. He wins. Principle 11. Volatility is opportunity. Paul loves volatility. 1987 crash? Opportunity. 2008 crash? Opportunity. 2020 crash? Opportunity. Paul's rule: when everyone is panicking, that's when you make money. Principle 12. Bitcoin is digital gold. 2020, Paul publicly announces, I'm buying Bitcoin. Why? Inflation hedge, digital gold, scarce asset. Result? Bitcoin goes from $10,000 to $69,000. Principle 13. Inflation is the silent killer. Paul warns, inflation destroys wealth silently. His hedge? Gold, commodities, Bitcoin, real assets. Principle 14. Central banks drive markets. Paul studies Federal Reserve meetings religiously. When Fed prints money, stocks go up. When Fed raises rates, stocks go down. Principle 15. Don't be a perma-bull or perma-bear. Paul is neither always bullish nor always bearish. He adapts. Bull market? He goes long. Bear market? He goes short. Principle 16. Risk management is everything. Paul says, I could teach you my strategy in 30 minutes, but risk management takes a lifetime. He risks 1 to 2% per trade, always. Principle 17. Discipline beats intelligence. Paul, discipline is more important than being smart. You can be a genius, but without discipline, you'll lose. Principle 18. Trade with conviction, not hope. Paul only trades when he has high conviction. If he's not sure, he doesn't trade. Principle 19. Philanthropy matters. Paul has donated over $1 billion to charity, education, poverty alleviation, environmental causes. His Robin Hood Foundation has raised $3+ billion. Principle 20. Stay humble. The market will humble you. Paul says, the market is always right. You can be wrong. He lost money in 2020 betting against stocks. He admitted he was wrong, adjusted, came back stronger. So what's Paul Tudor Jones' legacy? He turned $1.5 million into a $20 billion hedge fund. His personal net worth? $7.5 billion. His track record? 1987, plus 62% Black Monday. 28 consecutive years of positive returns. Predicted 1987 crash, 2008 crash, 2020 crash. Paul's philosophy? I'm always thinking about losing money as opposed to making money. Don't focus on making money. Focus on protecting what you have. So here's what you should do right now. Step 1. Study macroeconomics. Read The Alchemy of Finance by George Soros. Principles by Ray Dalio. Federal Reserve Reports. Understand how interest rates, inflation, and central banks drive markets. Step 2. Implement 5-to-1 risk-reward ratio. Before you enter any trade, ask, if I risk $1, can I make $5? If not, don't trade. Step 3. Always use a stop loss. Never enter a trade without knowing your exit. Risk 1 to 2% of your portfolio per trade, max. If you loved this breakdown, watch Ray Dalio's 20 Principles, Economic Cycles, All-Weather Portfolio, George Soros's 20 Rules, Reflexivity Theory, Breaking the Bank of England, Stanley Druckenmiller, Soros's protege, Macro Investing Legend. Hit subscribe. We break down legendary investors every week.